Hello and welcome to Investing in REITs, where we examine the growing role of REITs within India's evolving investment landscape. In this episode, we spotlight REITs as an investment asset class, the yield, stability, and portfolio role as well. Over the last few years, REITs have emerged as an increasingly important bridge between traditional real estate ownership and modern financial investing, offering investors access to institutional-grade commercial assets through a transparent, regulated, and listed structure. For many investors, REITs occupy a unique position within the portfolio spectrum, combining the elements of real estate, equities, and income-generating instruments. At a time when markets are navigating volatility, interest rate cycles as well, and we are talking about shifting allocation strategies, the appeal of stable cash flows, yield visibility, and professionally managed assets has become even more relevant. To discuss this and a lot more, we are joined by Abhishek Agrawal, the CFO of Embassy REIT. We also have with us in the studios Gaurav Kumar, the MD Capital Markets India at CBRE. Gentlemen, thank you so much for joining us today. And we talk about a lot of asset classes, and REIT is prominently becoming a big name in portfolio allocation as well. So, Abhishek, let me start with you first up. If we had to explain it to our viewers, we talk about fixed income, we talk about equities, we talk about mutual funds. But how do you explain them, what REITs really mean?
So REIT stands for Real Estate Investment Trust. Not to, go into that, but where does it stand in the whole investment spectrum? It is not fully equity, it's not fully fixed income. It sits somewhere in between that. And I'll explain why. REITs give the return to the investor in two forms. One is the fixed income, which comes every quarter, which is basically the rent that the REITs collect, less the expenditure, and that is distributed to the unit holders. So that is the fixed income category of the REIT. So you can categorize it there, a part of it. But it also gives the investors a chance to participate in the capital appreciation like equity. So it has characteristic of both of them. It is not very volatile as an equity, but is not fixed as a bond that you will get the guaranteed return. The returns are there. It's stable, it's predictable, but it is not guaranteed. So that's why I would classify REIT as both, and hence it sits in the middle. Generally we call REIT, you can think of income oriented equity, where it is also focusing on income, and it's a moderate risk, moderate return product.
Okay, moderate risk,
moderate
return. Let me come to you now, because SEBI recently reclassified REITs as equities now. There are mutual fund participations coming in, increasing now. How are institutions looking at this particular asset class? What is the activity that you've seen? A lot of tax changes, a lot of classification changes that we've seen.
I think from an institutional perspective, it's a great exit. And if you go back to the genesis of REITs, especially in the context of office spaces, even when it started in the US, it was basically to provide investors access to commercial real estate without exposing them to the risks of commercial real estate, right? So you get your yield in. It's very difficult to buy a shop or a floor and then manage it, manage the tenancies, manage the asset itself. Straight away, it provides a great avenue for investors to participate into office in a very, very transparent manner. To institutions, it's a great liquidity event, because what we are going through now is a stage 2 of institutional ownership. Stage 1 was when private equity came in, which were basically private investors or sovereign funds or pension funds, right? But when they built out these large positions in office portfolios, they needed an exit at some point in time. So it gave them that exit. At the same time, it gave retail investors a way to participate. So it's worked out beautifully. Institutions absolutely love it, but not for the same reasons as a retail investor would.
It is different for both the classes of investors. But to simply put, of course, I'll take this forward with you. But coming back to you, Abhishek, because you said it is a product which is a mix of what you would call equities and fixed income as well. It's like mutual funds, basically. The underlying is commercial real estate, and you can buy units, and then you can get returns and capital appreciation. Let's talk about the predictable or little less predictable cash flow that we are talking about. How does the distribution model work? What are some of the outflows that a REIT sees, or at least the inflows that an investor would see once they're invested into REIT? If you can bucket that for us for easy understanding.
Absolutely. See, why I was saying that it is more predictable cash flow is because what is the underlying for a REIT? It is all leasable assets. Let's say if we talk about office in particular, the leases span up to, let's say, 5 to 10 years, generally 5 years, with a lock-in of 3 to 5 years. Generally in the country, we see 5 years. So there is a predictability for the investors, for the REIT itself, that what are the cash flows that they will receive over a period of time. If you look at all the REITs portfolio today, the WALE, which is weighted average lease expiry, which is the balanced lease expiry period, is ranging between 7 to 8.5 years, which is quite a big period for the predictability to come in. Now, second part, how do REIT actually tackle this is when the REITs get the return, which is basically the rental income. What they do is they reduce all the cash expenditure, which includes maintenance expenditure, the expenditure for the, let's say if there is an AMC, so the expenditure for running that REIT, and the interest expenditure, which is also a big part of that. Whatever cash is remaining, at least 90% of that has to be distributed to the unit holders. So what a unit holder gets is a distribution of this cash, which represents basically the unspent portion of the rental. Now, for a investor, what he or she gets is basically a distribution. Why I'm calling it a distribution and not a dividend is because this distribution has 3 portions. One is dividend, the second one is return of capital, and the third one is classified as interest. There are internal policies, and SEBI has actually governed why these are classified like this. But this is what an investor should understand, that when he gets the distribution, it comprises of 3 parts.
So it's interest, it's your income that you'll get as
dividend,
a cash flow that will come out as a dividend, and the third one is the appreciation that an investor gets.
Return of capital, which is a return of capital. Okay. Now, the fourth part which an investor gets is the appreciation on their purchase price. Now, that one is basically like an equity share. Whenever they sell at a price which is differential to the cost price, that is the appreciation. Okay, so we'll discuss that in greater detail because there are a lot of tax implications to that as well. And everyone looks at returns post-tax now, right? CBREs, you're sitting at the center of deal flow. You've seen a lot of changes that has come by in the REIT process or REIT regulations as well. What are you seeing in terms of capital deployment trends? Are investors prioritizing this as a core? Is it a satellite portfolio? Are they looking at more yield generating assets when it comes to their investment priorities now?
Investors have always loved core in India. And, to give you a sense of scale, when Abhishek's REIT first listed, 25 million square feet was the size of the REIT industry then. Today, we are at 175 million square feet. So today, REITs own almost 175 million square feet, but this is not the only number, right? In total, institutional ownership of commercial real estate is 300 million square feet. Out of maybe 1 billion square feet, we're almost close to the 1 billion square feet mark. So our office industry has scale, which was never there before. Market cap in 2019 was, let's say, 270 billion INR. Today, it's 2 trillion INR. That's how the scale has increased. So institutional investors have always liked core to be their first avenue of coming into India. It's easy. You don't have to go through approval risk, construction risk, leasing risk, but also you're on a moderate return path, which they're okay with. So from their perspective, it's great to come in, build out office portfolios, buy office portfolios, list them. Tomorrow, you may have the concept of private REITs. You don't always need to have listed REITs. But coming in, going out, great. And so many successful case studies of people having made money. Foreign investors who've made money investing into core office portfolios. We have so many success stories now. And that's what's really attracting the rest of the world to come in.
And we're seeing a lot of transaction, right? We saw it with Prestige selling it to Blackstone, and there's so much interest coming by in REITs. Another follow-up to that, because considering the environment that we are in, when FIIs are pulling out money from equity markets, is this something that we could see in the commercial real estate market, which has seen so much trust coming in from FIIs? Are we seeing that?
So 2 very interesting things going on. One, if you ask Abhishek his profile of shareholders or for all the other REITs, domestic mutual funds are playing a very, very big part. It's not only FIIs. And the second is even private wealth going into domestic core office funds, which has nothing to do with the foreign world, right? Because with the dollar always a little volatile, it's a lot easier for domestic wealth getting mobilized into Indian real estate. And I don't think they are being talked about enough. There is so much wealth out there that is going in an institutional form, both through the listed route, which is REITs, and through private funds. So it's not just the FIIs. The FIIs is, of course, a whole new category of investors that Indian office owners have been able to discover through REITs by maintaining control over their portfolio. So Indian entrepreneurs never wanted to easily let go of their core office assets because it's difficult to build, right? It's difficult to get land, build and lease. So the only way you can control ownership is through the listed route, get a new category of investor. Plus, there is also the whole sponsor manager dynamic, right? So you can continue to manage your assets, earn the management fee as well. It's actually a win-win-win.
Okay, so just to follow up again, because it's a very interesting lens to look at it from, right? When we talk about private REITs, we don't have any in India, is my understanding. That's correct, right? So how would it work going forward? Do you think for anybody to participate into REITs, it has to be the listed way? Because we do have unlisted shareholding in shares, but would it work for REITs as well for an investor? Because we do get that question. What if we don't want to participate into REITs via the listed way? Do we have options?
As things stand today, no, but there are many private players who are seriously considering it. But then the ticket sizes will be higher because they don't have the ability to manage thousands or hundreds of thousands of retail investors, right? So that will be more for the ultra HNI category. But for retail investors, there is no better way to participate than going in for a REIT. Because even from a returns perspective, if you see the last 4 or 5 years, they've given very much equity-like returns. And all your, like he explained, all your dividend is very, very tax efficient as opposed to investing money into a debt instrument. So far it's been a no-brainer. It's worked very well.
It has. So
just to add one thing, SEBI today doesn't allow a private REIT. So like SEBI allows a private InvIT, but it doesn't allow private REIT as of now. So all the REITs have to be listed REIT.
Yes.
Currently.
So in that case, since the taxation is better than debt taxation, better than debt mutual funds, what is an expected return for an investor from all these 4 ways of getting a cash flow? And post-tax, what kind of yields can one look at on an average?
Yeah. So see, REIT for India at least, an investor can easily say that they can get a mid-teen return, which is 13 to 15%. And if you look at the 7-year history also, which is fairly small history, but then if you look at 7-year history, the returns have been around that 13 to 15%. Now, out of the total 13 to 15%, what has actually happened is almost 50% has come from the yield and 50% from capital appreciation. So that's what I would say an investor can look forward to over a period, long-term period, let's say 5 to 10 years. So that's the kind of return an investor can expect.
Okay, so how do we break it up? Like usually that 90% cash flow that you distribute, what is the basis of the interest payment? What is the basis of a dividend payment out of that and the return on equity that you see? Just for them to understand if they're getting the money, how do they tax it? How do they split it? And what works in favor of REITs as well in that distribution?
Okay. So for REIT, actually it doesn't matter how this is getting distributed, but it's a little bit complicated and it is driven by what SEBI has actually directed us. It's driven by the SEBI regulation. What happens is, there is a REIT, which is a trust. Below that, there are SPVs, which are basically companies. Now, these SPVs, these companies, which are wholly owned by the REIT, holds all these assets. When the asset earns that revenue, minus all the expenditure, as I was explaining before, whatever is the surplus cash, REIT says you have to distribute at least 90%. Today, all the REITs are distributing 100%.
That's
but
correct.
let's say going to 100%, this cash, surplus cash, has to be distributed to the unit holders. But how do you upstream from that SPV to the REIT? Because these SPVs are companies, and as per Companies Act, you can distribute as dividend only that amount which is coming as profit.
Okay.
Now, these SPVs have huge depreciation because
so
of
profits are low.
So profits are thin. Cash profits are more.
Cash profits are more.
So dividend is only up to the PL profit,
Understood.
which is the book profit. Now, the balance amount is distributed as return of capital and interest on that. Basically, REIT gives loan to these SPVs to invest in these buildings and all. So, repayment of that and the repayment of interest on that loan. Now, regulation says if REIT has received from his SPVs anything, when it distributes to the unit holder, it has to take the same color.
Correct.
What we think is, first do dividend, whatever is left, surplus, next comes interest. If still something is left, that goes as return of capital. So hence, this thing comes, it is, I mean, fully mechanical. I mean, we don't apply our brains there, whatever.
No, it's a very
it comes there.
comprehensive
Yeah.
breakdown, because it is not a simple company structure. You're making profits and giving it back to your shareholders, right? It goes via layers. So it's important to understand that. There's a lot that we are learning on the conversation right now, but we have to slip into a short commercial break. When we return, we'll continue the discussion on portfolio allocation, market resilience, investor participation trends, and a lot more. Stay tuned for that conversation. Welcome back to Investing in REITs on CNBC TV18. We are in conversation with Abhishek Agrawal from Embassy REIT. We also have with us Gaurav Kumar from CBRE, discussing everything about REITs as an investment asset class, yield stability, and portfolio role as well. So let's continue the conversation. We've been talking a lot about how this trend is improving in India, more listed REITs coming by. 2019 was the first REIT. We are in 2026 with 6 REITs now, which are listed on the exchanges. Gaurav, what is India looking like in comparison to global REIT market? Do you think we need more depth? And to do that, do you think we need more regulation or more ease of compliance to come by in order to do that?
I think we are very good from a regulation perspective. SEBI has done a great job in my personal view. You can expect to see at least 4 or 5 new REITs in the next few years. Like with everything else, our penetration is at a lower level. But having said that, if you have 175 million square feet out of a billion square feet already under REITs, it's not bad at all. It's almost 20%, right? There are 2 new big office players who are considering a REIT. There is going to be a logistics REIT very, very quickly, and maybe more logistics REITs as time come along. So we are not imbalanced in any manner at all. And these REITs are also growing through acquisitions, right? So the scale of these REITs is not just organic growth, right? A lot of them are acquiring assets, some of them their own sponsor assets, but now for the first time we are seeing REITs do third-party acquisitions, right? One of the dynamics of the trends was in the last 4 or 5 years that most REITs were buying assets that were developed by their own sponsors, but that's completely changed. We've got 3 or 4 strong examples of these REITs now doing independent third-party acquisitions. The other very important thing for their balance sheet is that their access to debt at a REIT level is a lot cheaper than what even a very good AAA rated Indian real estate balance sheet would be able to do. And your avenues of debt open up. I think from a regulation perspective, RBI is getting more and more liberal because they understand that these REITs are very, very professionally run. No one wants to be on the wrong side of SEBI regulations. At the private level, you can, there's still room for maneuvering. So I think you will see more REITs coming. You'll see more sectoral REITs coming. You might maybe see another retail REIT coming, another logistics REIT coming. So I think there's plenty of growth, and our fundamentals are so great. Just in the first quarter this year, we've already done 20 million square feet of space.
Yes.
Despite all the talk about what's going to happen to office space, the RFP pipeline for this year looks great. In fact, for the next 24 months, looks very, very robust. Plus GCCs, who are very, very strong demand drivers for office space, and they're also less prone to fluctuations, given what's happening to the rest of the world from a tech perspective. The more it's not great for maybe Indian IT companies, but as far as foreign companies setting up their own captive GCCs, we're seeing action outside the tech space as well. Everyone's only spoken about tech, but there is so much happening outside tech, whether it's in pharma, whether it's in fashion, and all of those GCCs will come in as well.
I know, and REITs are a lot about commercial, but there are other layers to it.
Yes.
And as you said, there are other sectors, just not technology, which will contribute to the growth that we are talking about. And GCC is a big, big part of that growth story that we are looking at. So rising absorption, that is something, of course, which is great. And inorganic growth, that is very important because Embassy has also made inroads in that, Chennai being the new one. But when we boil it down again to retail investors, because they want to know whether or not we should invest here. Institutions understand it well. As you've been pointing out, there is inflow coming in from mutual funds, be it other big institutions and private finance as well. What should an investor keep in mind, a retail investor, when they have to talk about taxation on these cash flows that are coming to them? Because it's different, because it comes under different headers for them as well, right?
So absolutely correct. I mean, this is a primary question also, because when the retailers invest and they see that there are 4 bifurcations, they get a bit bogged down. But what I would say is it is fairly simple. You have to classify it between 2 things. One is capital appreciation, which is similar to equity. If you hold it for more than 12 months, long-term capital gains. If you hold it for less than 12 months, short-term capital gain. Now comes the distribution part. Distribution part, as I was saying earlier, there are 3 components to it. And all these 3 components, the investor will get a mail from each of the REITs every quarter that what is the breakup of the amount that they have received. The first amount is dividend, tax-free. The second part is, let's say, interest. That is taxable as if it is your normal income. Whichever tax bracket you are in, you tax this amount then and there in that same financial year in which you received as per your tax bracket. The third component is return of capital. What the law says is just reduce your cost of buying a unit by this amount.
Got it.
Effectively, what happens is, this sounds complicated, but in simplistic word, you just park it. Whenever you sell the asset, put a capital gains tax on this amount also. If you held the equity for more than 1 year, long-term capital gain, less than 1 year, short-term capital gain. So it's fairly simple that way.
And REITs just give you a breakup as well while they're
Yes.
distributing it,
Yes.
because that's important how to figure out
Segment.
your tax liability as well. Very interesting, a lot more questions, but this has been a great primer for investors on in order to understand it from a macro perspective, what are big investors looking at as well, and from a retail perspective as well, what it really means, what kind of cash flows you can expect, and especially the kind of taxes that you have to pay as well. Abhishek and Gaurav, thank you so much for joining us today and sharing your insights on the evolving role of REITs. It's a very interesting topic. India is making strides here, and we have to see whether that continues or not. But as you say, we continue to do really well. Sectoral REITs are coming up. Thank you so much for explaining all of it to us, and thank you to viewers for tuning in as well. With that, it's a wrap on this edition, but stay tuned to CNBC TV18 for more news and updates.